If you're curious about the technical levels of mortgage-backed securities, I just wanted to give you a quick video here to explain what we're tracking. So the individual candles that you see represent the daily movement of mortgage-backed securities. The skinny lines show the highest and lowest they went in the day. The thicker part shows where it opened and closed, and whether it's red or green shows if it was up or down for the day. There are levels that represent floors or ceilings that tend to keep a lid on how much these move up or down. These are Fibonacci levels and different daily moving averages for 25, 50, 100, and 200 days. Day moving averages, that is. And there are also other technical drivers like upward and downward trends, previous highs and lows that the market's tested before. And basically, when prices approach one of these levels, it tends to either bounce or break through, and that reaction really tells us a lot about where things might be headed next. So looking at the short-term chart just today here, covering the last 30 days, you can see the price has been hovering right around that 100 level. There's resistance above at 100.13 and 100.03, and support below at 99.79 and 99.6. But right now, we're sitting right in that range, which means the market is deciding. So a move above resistance would be good for rates. A drop below support would put pressure on them. So on the one-year chart, though, you can see the bigger picture. Price really made a strong run up from the mid-97s in the summer, all the way to 100.84, which is that 100% Fibonacci level at the top. And that Fibonacci levels you see are basically areas where markets historically tend to pause or reverse. So the 23.6% level at 98.58 was the first major floor on the way up, and it held. If things were to pull back from here, those lower Fibonacci levels at 97.19, 96.06, and 94.93 would be the next areas to watch. Now at the bottom of both charts, you're going to see the stochastic indicators. This measures momentum, so when the lines are above 80, the market is considered overbought, meaning it may have moved up too fast and could pull back. When they're below 20, it's oversold, meaning the opposite. So one of the most useful signals is when the two lines cross over each other. A cross moving downward from the overbought zone is often a warning sign, and a cross moving upward from the oversold zone can signal a potential bounce. So on the 30-day chart, you see the stochastic is currently dropping toward the oversold zone after coming off a high. That is worth watching. And on the one-year chart, you can see how each time the stochastic hit oversold and crossed back up, price did tend to recover shortly after that. And that pattern's repeated several times over the past year. Obviously, none of this is a guarantee. Technical analysis is really just reading probabilities, not predicting the future. But when multiple levels and indicators line up, it does give us a stronger case for, making a move or waiting. So if you want a simple reference guide for what all these terms mean, I put together a quick cheat sheet that you can keep. And as always, if you want to talk through what this means for your specific situation, I am one call away. Something that is important to note as of right now is that big world events, like what's happening, do tend to kind of negate the technicals and take precedent over that. But again, if you've got any questions or if I can help in any way, just say the word. Have a great day.